I once turned a 500% profit into a loss. I was sitting on a gain that big, I refused to sell a single dollar of it, and I round-tripped the whole thing all the way back down to nothing. Today, I'm going to share the top 5 mistakes I made after investing for 10 years, and losing that gain was only one of them. I'm not a newbie in the market. I had been an investing coach, and I used every investing tool you can name. Yet, I still fell into those traps. Each one happened when it felt easy. That is the pattern. When investing feels easy, that is usually when it is about to cost you. I believe you will learn something new by the end of this video. So check which of the 5 are already yours. Mistake number 1. Falling in love. In 2021, I told hundreds of people to buy CrowdStrike. I bought it myself at around $200 a share pre-split. I loved this company and I said so on camera every single week. Then it fell to below $100 in 2023. Adjusted for the split that came later, that is about $25 in today's price. A stock I loved, a stock I put my name on, cut in half, with other people's money riding on my call. The worst part was not even the loss. It was the quiet question of whether I had just let all of those people into it. So I held on through all that pain. And today, CrowdStrike trades around $194, which is well above $770 in the old pre-split price. So holding won. The love paid off, right? That is exactly the trap. Because I loved another stock the very same way. Same conviction, same weekly call, same promise to my students. It was Unity. I bought it above $120 in 2021 and held it through the losses exactly the same way. But this one never came back. In late 2024, I finally cut it at around $30 a share. Same love from me. One climbed to new highs, the other I had to sell at a deep loss. So here is the real lesson. Loving a company is not the mistake. The mistake is thinking love is enough. Love is one thing. Timing is the thing that pulls that money into your wallet. When you love a company, you have 2 honest choices. You buy and sell at the right time and take the profit. Or you buy at any price and hold forever. Most people believe they are the second kind. Then the price falls by half, they sell at the bottom in fear, and they call it discipline. Loving a company can slowly cost you. What I did not expect was that hating one would cost me just as much. Mistake number 2. Hating a company. There was one company I could not stand, Palantir. Back in 2021, I watched it drop from $45 to $20. I told people to stay away. It then fell below $10 and I felt smart. But my reason was not the numbers. It was the CEO. On the 2022 earnings call, an analyst asked why customers pick Palantir over building their own software. In his answer, he said the US government tried everything not to buy the product, so they had to sue it twice. Then he said, and I'm quoting him, "Just imagine how popular I am." The message underneath was simple. My customers hate me, but they have no choice. To me, that was pure arrogance. I decided the company was not worth my money, and 4 years ago, I even dropped it from my coaching model portfolio for that reason. And nothing about him has changed. A few days ago, on July 1st, 2026, he went on CNBC and ranted for almost 20 minutes, called the AI industry effing insane, and told the anchor he was the voice of American business. Same person, same character 4 years later. Here's what hating this company cost me. Palantir hit an all-time high above $200 in November 2025. Even now, near $129, if I had just bought it at $10 and done nothing, I would have more than 10 times my money. With CrowdStrike, I loved a company and held it blind. With Palantir, I hated one and stayed out blind. To your wallet, love and hate are the same mistake. So here is how I changed. I put the feeling second now. I read the market's sentiment first. If the trend will push a stock up, I buy it even if I do not like the company. And when I love a company but the market turns against it, I trim anyway. So loving cost me. Hating cost me. The next one cost me even though I was right. Mistake number 3. Waiting for more. Let me take you back to that 500% gain. It was one of my crypto coins and the profit was sitting right there on the screen, real money. And do you know what I felt? Not joy. I felt that it was not enough. I started dreaming about 10 times my money. I was already counting the profits I had not made yet. So I held the coin. I did not take a single dollar off the table. I even put more money in because everyone in the community was sure it was about to climb even higher. And then it fell. Not a little. It dropped 90% from top. The whole gain handed itself back day after day, and I kept waiting for it to climb back to where it was. Luckily, this was a small part of my portfolio, under 10%. But the lesson is not about the size. It was about the feeling. Money is money, whether it is a worthless meme coin or a generational public company. Here is the trap inside taking profit. There are 2 ways to feel like a fool. You sell at a 25% gain, then you watch it run another 200% without you. Or you hold it through that 200%, you refuse to sell, and you ride it all the way back down below where you started. I have felt both many times. And the second one is worse because the profit was already in your hands and you chose to keep waiting until there was nothing left. Selling early feels like you walked into a casino, won $20 on the very first game and left straight away. Holding too long feels like watching an ice cream melt in your hand while you do nothing. The market never really sends you a message that says,
"This is the top, sell now."
The signal is quieter than that. But some people always seem to feel it before the crowd does. How do they do that is the whole point of mistake number 5. Now I have already shared 3 mistakes. Which one have you actually lived through yourself? Tell me below, I want to read your stories. And if this is useful, hit like and subscribe. It helps the next person who needs to hear this find it. Mistake number 4. The loudest room. Back to November 2021 with me. Tesla was all anyone could talk about. Every video, every group chat, every news article. The retail crowd was louder than I had ever heard it. And I was right there in the middle of it, just as loud, just as sure. That noise felt like safety. So many people could not all be wrong. That is what your brain tells you. The comfort of the crowd feels like confirmation, it feels like proof. It was the exact top. From there, Tesla fell about 75% from its 2021 high all the way down through 2023. It had only climbed back over these last 2 years. For years, I read this signal completely upside down. When the courage is at its highest, when everyone around you agrees, when the dream looks the easiest it has ever looked, that is not the green light, that is the warning. The easier the story sounds, the closer the trap usually is. And I did not learn it the first time. In late 2024, I felt the same roar again with crypto. Everyone said Bitcoin was going to 200k. The bolder voices were calling 500k or even 1 million. Every altcoin was going to multiply. The room was loud and sure again, and I leaned in again. The crowd is the loudest at the exact moment it was most wrong. And when you are inside it, it just feels like belonging. The hard part is this. Being in the loud room feels good. Stepping out of it feels lonely and early and sometimes foolish. But that one moment in November 2021 did more damage to me than any other. And the next mistake is the reason why. Mistake number 5. Everything on one stock. This is the one that hurt the most. By late 2021, more than 80% of my money was in Tesla. Not a slice of my portfolio, almost all of it. It did not start as a reckless bet. I bought Tesla back in 2020. It went up and I took those profits and put them back straight into more Tesla. I even bought call options to push the returns harder. Every win made me more sure, and every time I got more sure, I put more in, until more than 80% of everything I owned was riding on one company. Then November 2021 came, the top, and over the next 3 years, that 6-figure position fell by close to 60%. Here's what nobody tells you about being this concentrated. When almost everything you own is in one stock, a bad month for that stock is a bad month for your entire life. There is no other green on the screen to soften it. Your savings, your years of work, your future plans, all of it moves with one ticker. I would check the price and feel my own sense of security rise and fall with it. By then, I was not really investing. I was making one giant bet with nothing to catch me if it went wrong. It took 3 full years for Tesla to climb back to where it was. 3 years of my life just to get back to even. I did not lose because Tesla was a bad company. I lost because I left myself no room to be wrong. Now, I know what some of you are thinking.
People go all in on one stock and become rich.
It happens, it is real. But look closely at the ones who actually do it and survive. They are not aimlessly scrolling social media, consuming whatever stock discussion is put in front of them. They study the market almost every waking hour, 12 hours a day, sometimes more. They dig for what the rest of us cannot see, and they connect it before the market does. That is where their edge comes from. The all-in did not make them rich. The work behind it did. And that work is the one thing I'm still learning, even 10 years in. Let me take you back to where this all began. 10 years ago, I was a university student. My first ever investment was an ETF I bought through an ATM machine in Singapore. I put in $100, the fee was $1. Back then, that was the cheap and easy way in, because the traditional brokerage charged at least $25 in commission and wanted thousands of dollars just to buy a single position. That was before the low-cost apps existed. I tell you that because here is the thread running through all 5 of these mistakes. Every year I have been investing, the tools have gotten easier. The ATM became a free app. The free app now has AI built into it. One prompt and you get a full breakdown of any stock in seconds. And every single year that it got easier, I did not get better. I made these same mistakes with better and better tools in my hand. So here is the uncomfortable truth I want you to know. Easy access was never the edge. When everyone can pull up the same data with one tap, that data stops being an advantage. When everyone can build an app with one prompt, having an app is worth almost nothing. 5 years ago, building an app could earn you a living. Today, it is one sentence and a few seconds. The tools got easier, so the bar to actually win got higher. This was always supposed to be hard. The edge was never the app, or the data, or the AI. The edge is the work almost nobody is willing to do. So the real question is not whether you know these 5 mistakes now. You do. The question is what you do the next time investing starts to feel easy. Because that feeling will come back. It always does. So which side of you will end up on? The side doing the quiet work, or the side that becomes someone else's exit? Only time will answer that. I will be here when it comes around again. If this video is useful, hit like and subscribe. I go 3 layers deep every week.